on a breakdown, you put your risk at the high, and from that point, the market should establish a direction. The main thing is the prior range high, where the market broke from, is called the gap close. Here, this is also called a gap close. There's two ways to look at it. You can look at the prior high on the market, and the markets more or less attract to the prior swing high. In this case, this is the prior swing high. I don't need to give you 100 different examples. One example is perfect, and if you understand the perfect example, then you've got the game beat, okay? There's never going to be a perfect example. The main thing is you just want to get the direction correct, and once you get the direction correct, all else is easier. As the markets move in your favor, you want to peel off positions, which means you want to exit partials on the way down and move your stop to basically an even position. That way, if the market comes back up, you don't lose. And you want to continue to trail the market. Once you break out the first half hour or hour, depending on what you like, I like the first 30 minutes. Once you determine that direction, that gives you the main trend for the day. It could be going forward. You just want to see how far it goes. You should not have to worry about the market coming back against you. And from that point, you then start looking at prior swing highs, gap closes. This is also a gap close. There's two types of gaps, which means that the market at a high, it closed here, the market opened. This would be a gap close, and this is also a gap. One's called a lap, one's called a gap. It's pretty much the same thing. Professional traders like to look at prior swing highs and prior swing lows. Most important part of your chart is that. All right. Once the market breaks down from that range, you then want to bring a break-even stop and just let the market play itself out. Okay, and look to play for the gap close. I hope this video made sense to you. I didn't think it was relevant to put any kind of trade out today, but I thought an educational video would help you understand how to trade gaps into the future, and that if we ever see it again, you know what you need to do. Take the first 30 minutes of trading, take the range high, the range low, and you sell a breakdown or you sell a breakout up. Now, if I was looking at this and say, okay, how many pips are involved? So let's just say from here to here, you have 40 pips, hypothetically. Okay? So 40 pips, you do your math, depending on how your account size is, and then you come up with your risk ratios. Very simple. For instance, one mini would be 40 pips, $40. $40 on $1,000 is 4%. So $1,000 account on 40 pips on one mini, that's 4% risk. Let's just say you want to do half of that. You use 5 micros. Let's just say you want to be more aggressive. You do a mini and a half, mini and 5 micros. So keep it simple. It's KISS. Keep it simple, stupid. And that's me. I like to call myself stupid sometimes. Anyway, listen. We're all professionals here. We're all in this game together. We're all here to succeed. And my job as CEO of the company is always to find things that are important and bring them to the table for you, not to sit and put you in positions and trades that will not make sense. My job is to protect you. You'll see a lot of times maybe the swipe trades, Justin won't trade, or maybe the fusion or FX signals live, or maybe there's no calls on the daily swing trades. That's because I'm in the background saying, listen, guys, be careful. Or maybe in the live IML rooms, be careful because it's a holiday, because of volume. Always important. Respect volume. Respect the day before, respect the day after a holiday. All right? What we saw here today, that gap up, it changes the whole game and everything changes, and that's the nature of the beast. You just have to know how to react to an action that has occurred. Anyway, we spent about 10 minutes babbling. I hope this has helped you. please share it with everyone you know, because it's real important how to handle gaps in the future, not only in the Forex market, but in the stock market, but in the commodities market, but in the futures market, the bonds market, or any other markets that you watch. I watch gold, we watch everything, oils, and that's most important. You could test it out. You could